Mean variance optimization is a foundational framework in asset allocation that helps determine how to allocate capital across different assets in a way that balances risk and return. It also identifies the portfolio that maximizes the Sharpe ratio, delivering the highest return per unit of risk. This approach forms the basis of modern portfolio theory and is widely used in both academic research and professional investment management. On the right, a Monte Carlo simulation illustrates this concept in action. Each point represents a portfolio created by assigning different weights to each asset. By randomly varying these weights, a wide range of possible combinations is generated, each with its own expected return and volatility. As more portfolios are generated, more efficient combinations begin to emerge, gradually forming the outer boundary of optimal portfolios. This process visually builds up what becomes the efficient frontier. The most efficient portfolios lie along this boundary, known as the efficient frontier. It represents the best achievable trade-offs between risk and return. For any given level of volatility, portfolios on this frontier offer the highest possible expected return. Along this boundary, two key portfolios can be identified: the minimum variance portfolio, which has the lowest possible risk, and the portfolio that maximizes the Sharpe ratio, which provides the best risk-adjusted return. In the next section, it will be explained how this optimal portfolio is derived using Merton's propositions. Let's start coding. And one of the most important things to know about the MVO is that most of the times we're going to be using something called vectorized operations. And why? Because we'll be dealing with more than 100 assets. And vectorized operations, you optimize computational power because they work in parallel. And because of that, well, we're gonna kind of need to memorize some formulas, which are like linear algebra, matrix multiplying, and we're gonna be always using it. Also in SciPy, these are like kind of the parameters, and I'm gonna show first some examples using Merton propositions, and lastly we're gonna start using the SciPy library for optimizations and constraints. Starting here, I'm gonna use SPY, gold, emerging market pair bonds, TLT, and develop excluding US equity as examples, but this is very basic. There are a lot of asset classes you can use for it. I'm not gonna get in detail about capital market expectations or like which asset classes you should use, because this video is more focused on the algorithm part and how you should do it. And well, first thing, basic, we got the data on Yahoo Finance. After getting all the data, you also go to the Fred API to get the treasury. So I got in the 5 years treasury, which is this series here, the GS5. And well, from the last date, today is 23rd of March, so the 5-year treasury right now is 4.01%. This is gonna be kind of the risk-free. It's not exactly risk-free, but it's gonna be the discount on the Sharpe ratio, because there's also term premium here. And well, starting with the log returns, this is like an unusual way that I learned how you can use it, but it's kind of intuitive. I'm basically, imagine you're excluding the first line here and dividing by a value that you exclude the last line. So for example, imagine I have like 10 lines. I have from D0, D1, D2, D3. Basically this line here, you're excluding the first line, so you're getting D1. And this line here, you are excluding the last line, so here you're getting D0. So it's basically D1 divided by D0, the algorithm, of course. And the same thing, like here you get D9, which is the last line. And here, since you exclude the last line, which is D9, it's gonna be D8. So yeah, that's how you do it to get the returns by using NumPy. Then you get some basic analyzed statistics. And well, the first thing, like, it's not complicated. This is just like you can use NumPy. You have all the functions here. And well, basically there is this DDO here. It's kind of relative. Some people prefer to use 0, some people prefer to use 1, because 0 is population, 1 is a sample. Well, I'm getting 5-year sample, so I prefer to use this way. But I've seen some arguments from people that just want to use 0, so it depends on your assumptions. So here's some basic. statistics. So yeah, I'm getting, guys, be careful because this is historical returns. Historical returns right now doesn't mean that it's gonna be good in the future. Gold just plummeted recently, but if you get a 5-year history, of course it's gonna allocate. And also gold not to, is very low correlated with other asset classes, so of course it's gonna force allocation a lot to gold and SPI probably. And well, you get also the volatility and the variance of each one. Okay, so let's get the covariance and correlation matrix. And again, you can just use NumPy. And again, it's important to use this row var equal false. Why? Because the assets are in the column and the data is in the rows. And usually this come as a default as true. You should change to false since the assets are in the column. So always when you calculate covariance and correlation, always put it false. So quite basic. I'm gonna show like an example of how you would calculate these values with a matrix. Let's see like an equal weight portfolio. Let's get like a number of assets we have. Use len and tickers, and it's gonna be like 5 number of assets, and then you get the weights. I want equal weights, so it's gonna be like an equal one. So it's a Google Colab, really helps a lot. And if you NumPy ones, which means like I'm gonna, since number of assets is equal 5, I'm gonna have like and NumPy ones, which are, I'm gonna show an example. I'm gonna have like an array of 5 number ones, and each one of these arrays are gonna divide by the number of assets, so it's gonna be like 0.2, for example. So I create this array here of 0.2s. Oh, okay, so now I have the weights. Now let's get the expected returns, like by using matrix multiplying. Yeah, like this is the transpose, and this is the multiplying. And what is this saying? I have the expected return, like a matrix, an array. I'm gonna kind of transpose, like do like this, like you see my camera, like to multiply it by the weights. So the expected return is gonna get like, I'm gonna multiply weight 1 times the expected return 1, then expected return 2 times the weight, and it's gonna be all the sum of all this. Like it's gonna give me all the expected return, and yeah, 0.06, and then the volatility, which is the let's start with the variance, which is the Google Colab basically it's giving everything already. Well, which is that formula. This is the transpose of the weights times the covariance times the weights. Remember, guys, this you always should use this as times when you're multiplying matrices. No mistake, guys. We should put the one in here. Now we're gonna rerun the code, otherwise it's gonna bug everything. And well, here we have the first proposition from Merton, and basically the optimal weights it follows like this weird formula here, which is the inverse of the covariance times the expected return minus risk-free. And well, putting this formula here on paper, you'll get like these weights here. The difference here is that like when you use Merton proposition, you can have negative weights. The sum of everything will be 1, but you have like negative weights here, which most of cases is not practical. But let's follow here the Merton proposition one before we go to the SciPy library. And here you can check all the weights equals 1. The expected return is likely very low, and yeah, you have like this volatility and a negative sharp. When you have negative weights, that was considered the optimal allocation using. Having two assets like SPY and gold, for example, you can follow this classic formula here of the variance. So here I selected all the data of the SPY and gold and plotted on an efficient frontier, which is basically the weights of asset 1 and 1 minus weight from asset 2. following this formula. So I get the returns and the weights, and I generate this array of all weights, and for each different weight you're gonna have the return and the volatility for each asset class. So yeah, guys, it's possible to do some kind of optimization without the SciPy library, just using the NumPy, but it's not recommended because you will need to do a lot of manual work. You're gonna have to do some crazy algebra things, and the constraints is gonna be something complicated to implement. But always following the propositions of Merton when calculating. And yeah, well, let's start with the SciPy optimizer. Well, we start using the function of negative sharp. You don't maximize a function, you actually minimize the negative of the function. And here we have all the formulas we worked before, and it's very important because those formulas are the arguments. Part of them are the arguments, and you're gonna return negative sharp ratio based on these values here. And well, let's start here with the constraints. And basically, what is this crazy thing? I want, for the normal portfolio, I want all the weights to be equal 1, and this time I'm gonna assume that there's no short selling, so all the weights should be 0 or higher. And well, here I have an equation. And what does this mean? Well, like imagine you put this weight like on the other side. Basically, it's gonna mean the weights should be higher or equal to 0. And this is the equation, which means that the sum of everything should be equal to 1. And well, for safety check, you can also define a tuple to define the boundaries, which goes from 0 to 1. And well, here we have the result. You basically put this function here of SPO minimize, well, the parameters. Okay, which function I want to minimize? I want to minimize the negative sharp function, which is the one here we defined. What are the arguments I'm using? Well, those here, those that I defined. The weights, the expected return, the covariance, and the risk-free. And what I'm gonna receive the weights. That's what I'm gonna receive as a result of this function. Those are the constraints I decide with these equations and equations, and these are the boundaries, which goes to 0 to 1. And as a result, I have basically locating gold and SPY. Why? Because gold, high returns in the last 5 years, and very low correlation with other asset classes. Let's see what is happening here. I received this object here, result P1, and as you can see, these are the attributes of this object. So the function it give me a negative sharp ratio of 0.8, and I got these weights here as defined. And well, we also have these other variables here, which can be used for other data regarding the results of the operation. But I mean, the most important data right now, it's gonna be like this .x. Why .x? Because of this attribute here. So it's dot and then an attribute. And well, that's basically what it's giving here. I'm gonna show her here one example. See. It gives like all these values here. And if I do the same thing, I want the sharp, I put here, that's fun. So this is how you get the data from these from the optimizer function. I'm gonna now build a portfolio 2 called max 30% of allocation. This is a constraint. I need to build another equation after this, which means that each asset class should have a weight lower or equal to 0.3. So basically, I had here like 0.6 of gold. To go below, it's gonna be to 0.3. This is gonna force a lower sharp ratio, but a more diversified risk. And well, again, a tuple. The boundaries range from 0 to 0.3, and we have the results here. SPY gold, and emerging market bonds, and develop equity. And the Sharpe ratio is a lot lower, but it's more diversifiable. And I'm going to another example portfolio, one that is excluding totally gold. And here I have to use one equality, which is gold being equal 0. So it's the same thing. Imagine that you're like putting on the other side of the equation, and this is going to be 0. Well, again, like a tuple. And here I have the results of everything. And well, surprisingly, it allocated everything to SPY. It didn't diversify in other asset classes. So in the end, it got a large Sharpe ratio, but it's very low. It's like half of the first portfolio. And well, here we have a summary of everything, the results of every portfolio. Yeah, it's gonna, of course, to gold. You do like 5 years, 10 years, 3 years, it's gonna be all the same if you're based on historical data. Sometimes they're gonna allocate to emerging market securities, but not always. Is never allocated into TLT because they had like the 10 years bonds. They had a very bad returns on the last years, and the correlation has not been that low as to being an incentive to allocate to TLT. Now let's go to the most complicated part of the code. I'm probably gonna do a separate video to explain this with a more deep detail because there's a lot of information about the efficient frontier. Well, I'm gonna create this function here called a build frontier, and I know there's a lot of things happening at the same time. What is this? I'm creating a function to see what are the lowest and the highest return for each portfolio. So for example, this is the case. I have asset A and asset B. The lowest return, imagine this is like a TLT, some class with a negative return. Imagine that it's gonna be 100% allocated to TLT. It's gonna have the lowest return at all. And imagine it's like a gold, which had the highest return. 100% allocated to gold, it's gonna have the highest one. And basically this is what the function is doing. It's getting a result, the SPO minimize a function of the return. So I'm gonna get the lowest return I can get, and I'm gonna get the weights of what is the lowest returns. And here is the same thing, but I'm getting the maximum return because it's like minimize a negative. So I'm gonna have like the positive return. Yeah, so like max returns, max weights, max returns weights, sorry, lowest returns. And here I'm gonna have the maximum returns weights. So okay, I got my weights here, and now I'm gonna input those weights. Remember the .x, and multiplying by the expired returns, and I'm gonna get like the minimum return and the maximum return to each portfolio, like this one I showed you. And well, after that, I'm gonna use something called the minimal variance portfolio. Okay, what is basically I'm doing here? I'm generating different returns, and all these returns you're gonna have a certain variance. What I'm doing here is like I'm getting the minimum variance of each all. So yeah, this is basically what this function is doing. It's a function to get what are the combination weights that will give me the lowest variance of all, and then based on that I get you get the weights. And well, and here where I start to get the real data. And this is something important because I'm divided into two, R upper and R lower. What is this function doing here? I have a certain number of points. I define here the number of points is like 500. So in that curve, I'm gonna draw like 500 points. I'm gonna first draw the upper part. What is the upper part? Is this green part here. And so I'm gonna start from the minimum variance portfolio until the maximum return, and I'm gonna put like 500 points. Until I make the curve. And what this function is doing. And the results, again, I'm gonna get like for every return, I'm getting the SPO minimize to get the lowest variance, and this is the target. This is like an equality function, and I want all the results to be equal t, and the t is a target return. I get like a lot of different targets returns, and for each target return I want to minimize the variance, and well, I'm minimizing this function. And guys, this is extremely important, and I noticed this just by doing that. If you don't the minimums, the SLSQP, which is like minimal squares, guys, you're gonna have some zigzags, and it's very bad, especially if you're doing with a lot of points. The optimizer is gonna get crazy, and it's gonna give you some of those crazy zigzags in the frontier, so it's not good. This is why you always should put a method when you are drawing the efficient frontier, because you're using a lot of different points that one next to each other. And well, basically this is getting me all the points, all the different points in when is higher than the mean variance portfolio. And here the same thing, but I'm getting the lower points. And the difference between those both functions is this one. I get from the mean variance portfolio until the maximum return, and here I get from the mean variance portfolio until the minimal return. And it does basically the same thing. And well, after that, I created this function here that again I'm defining the limits. I not use the same bounds, the same function that I was defined before, because this is not a minimize sharp. This is a minimize variance. So yeah, you basically get these boundaries functions, and after that you get all these numbers here, the returns and the standards deviations that are above and that are below in each different function. And well, this is the most important part. Here is like I'm plotting. I'm getting this function here. I am drawing the capital market line, and well, I'm getting the upper branches, the lower branches as it was defined. I'm getting where are the optimal portfolios, in which point of the efficient frontier I maximize my Sharpe, and I get the returns of each asset in the plot. Together with the risk-free rate, and well, our result you have this. This is the long-only portfolio. You can see it makes this curve, and this is the maximum Sharpe point, and this is the lowest bound for every one that is lower than the minimum variance. As you can see, is everything allocated to TLT. And well, you can see the restricted, the 30% portfolio. The curve is a bit smaller because the interval of negative and maximum positive is smaller, because you cannot concentrate 100% of assets in just one portfolio. So you can see it's lower. And yeah, here you can have 100% allocated to gold. So you have like a potential higher return here in this one. So in the end, the most effective portfolio is the long only, because you don't have constraints, so you can get a higher Sharpe ratio. And the efficient frontier, you have a more like, you know, potential higher Sharpe ratios than the other portfolios. So guys, I hope it was clear, and see you in the next video.